I think it's so important that we start to normalize the possibility of measuring things in Bitcoin as a way to think about a benchmark for outperformance. It's very hard because we live in a very privileged country where dollars actually is very useful, very powerful, and day to day, it's the utility to which we measure by. But at the end of the day, even the dollar is not avoiding or inescapable from the general kind of fiscal dominance that is happening globally. And it's time for all investors and operators and people in the space here to think about returns denominated in something that's a little bit more pure, that actually stands for a store of value.
Bitcoin surged from around $112,000 to $116,000 within minutes on Friday after Federal Reserve Chair Jerome Powell hinted at potential interest rate cuts during his speech at the Jackson Hole Economic Symposium. Powell's indication that current inflation and labor market conditions may warrant adjusting the Fed's monetary policy stance immediately triggered volatile price action across cryptocurrency markets. Jeff Park, partner and chief investing officer of ProCap BTC, describes these rapid gap moves as moments when market excitement peaks, fundamentally shifting the relationship between spot prices and volatility. Friday's price action exemplified this dynamic, with Bitcoin's swift 4,000-point climb demonstrating how quickly the cryptocurrency responds to Federal Reserve policy signals. While most financial professionals view volatility negatively, Park argues it serves as a valuable tool for risk management and yield generation. He explains that Bitcoin's volatility is by design. Unlike fiat currencies that maintain price stability through flexible supply, Bitcoin's fixed supply makes price the natural outlet for market volatility. Despite such dramatic short-term movements, Bitcoin has matured considerably over the past decade. Its annual volatility has dropped from nearly 200% to approximately 38%, indicating growing market stability even as significant price swings still occur during key events. Bitcoin maintains its high exchange rate primarily through investor demand driven by return potential, while its fundamental value stems from its ability to function as an alternative to traditional currency. If you found value in this breakdown, make sure to like, subscribe, and share it with fellow investors who are following these shifts. We'll continue bringing you clear analysis and insights from voices who truly understand what's unfolding. Thanks for tuning in.
Most of us, I think, in the financial services industry are taught to be afraid of volatility or to think of it as something to be less desirable. But the reality is volatility, if harvested correctly, can actually be a very useful tooling for not just risk management, but also for yield generation. And at the core, Bitcoin's volatility is very much a feature. And it is really designed within its monetary construct as to the fact that there are really two trade-offs you can make in the design of money, which is that if you want price stability, you have to have quantity stability as the thing that you might have to trade away, which is the basic foundation of our monetary policy with fiat. But the flip side of this is actually if you fix the quantity, well, then by definition, the price has to be the outlet in which there is going to be volatility. And that is, in fact, a healthy thing. That is the natural design of what money can be. And so I think Bitcoin, it's garnered a lot of attention, mostly because of the volatility. In a way, that in itself is a bit of an attention economy in itself. And the reality is a lot of young people do gravitate towards volatility as a source of alpha, as a source of generating wealth. That is not exclusive to just Bitcoin, in my opinion. It's actually fairly present in the retail investing world broadly, within the way that people want to express views on small market cap exposures, or event-driven risks that are coming into play by activism and whatnot. So I think the unique opportunity here is as institutionalization has taken Bitcoin to higher thresholds of ownership, what is the level of volatility that we can expect going forward? And there, I would say volatility is a nuanced definition and metric in itself. Most people think of volatility as the standard deviation in percentage terms of an asset's price, and that can be measured monthly, quarterly, yearly, etc. But it's a close-to-close observation. What it means is that it doesn't actually accurately capture intraday dispersion. So if a stock went up a bunch and then came down at 4 p.m. the same day, it would look like it's a zero vol asset. But we all know that was not a zero vol day. And intraday volatility in crypto is just as important as close-to-close volatility. So that's the first point I would mention about what's really unique about Bitcoin. And then the second thing is there's second and third orders of magnitudes with volatility measurement too. So for example, volatility exists in a range of distribution, but just because it steadily exists in that range of distribution in a normal and predictable way, doesn't mean it's not a volatile asset either, meaning the jump risks on the left and right tails also quite matter. So if something is steady for, let's say, a month where the volatility is 30, and then one day it has a 200 vol day, some might still say that average blended volatility is not very high, but you and I as humans know that was a volatile stock or a volatile asset or a volatile day. And the beautiful thing about Bitcoin is it actually exhibits a lot of fat kurtosis. There are days when Bitcoin gaps. This is when people get really excited, and the volatility and spot relationship often changes during these moments of asymmetric performance. Today is actually a great example. Today's a great example that when Powell came out with his announcements on how he's redesigning and rethinking about the monetary framework for monetary policies, Bitcoin gapped. It was a big move.
112,000 to like 116 or so.
Yes, in a matter of basically minutes. And that is maybe not noticeable as a close to close rolling day observation of volatility on a daily, but on the intraday, if you are present for that price action, that was pretty important.
Traditional commodities markets operate with significant opacity, according to Jeff Park. He notes that volumes are often hidden between market makers and producers, making it difficult to see the complete supply chain. This lack of transparency creates opportunities for skilled commodities traders to generate substantial alpha by navigating information asymmetries. Trade restrictions have intensified these challenges, increasing price uncertainty and volatility across commodities markets. Park observes that commodities now trade at different prices across various geographies, typically occurring when markets operate in closed-loop trading blocks rather than globally. The World Bank recently concluded that traditional commodity cycles, historically multi-year events sometimes part of larger 10 to 15-year supercycles, are fundamentally breaking down, adding further unpredictability to an already fragmented market structure. Bitcoin and cryptocurrency markets operate differently, with much of their crucial information publicly available. Park explains that this transparency creates a more level playing field compared to commodities, where information advantages are typically reserved for well-connected traders with privileged access to supply chain data. This openness is demonstrated through professionals like David Lewan at FalconX, who publishes comprehensive market depth data showing potential 5% and 10% price moves and bid-offer positioning. Significantly, this valuable market intelligence comes entirely from publicly available sources, highlighting how cryptocurrency markets prioritize transparency over the information hoarding characteristic of traditional commodities trading. Let's get back to the interview.
When you think about the commodities market, it's fragmented. The volume is often hidden between market makers, and the producers play a really big role, of course. And so you can't often get like a very clean picture of that supply chain, which is why there is so much outperformance and alpha to be had if you're an excellent commodities trader. But in Bitcoin and crypto at large, all of this is fairly public. So my very good friend at FalconX, David Lewan, he publishes the depths of market with kind of 5% moves and 10% moves and where the bid offers sit. And he aggregates all these informations just using what is publicly available. And that in itself is actually a really powerful signal to anticipate breakouts. Mm-hmm. Because if you see liquidity decreasing on the ask side and you're actually seeing the buildup on the bid side, you can start to get a sense for, oh yeah, there's actually momentum here. There might be a little bit of a supply. So today, institutions by and large have mostly accessed crypto products through regulated securities and commodities futures. So the ETFs play a big role, of course, and then the CME futures contracts play a big role, of which most of the derivative trading volume, I would argue, still happens offshore. And so when you look at the CME, for example, yes, there's open interest in the futures, and that often is used as a way to trade basis with spot. But the options market on those Bitcoin futures is actually pretty abysmal. There's actually no liquidity out beyond 1 month, almost zero. It doesn't mean you can't trade there, but it shows you institutions are not there yet. And I think because of that, there are some unique opportunities where oftentimes I've found that the volatility surface for the Bitcoin ETFs are actually a little more rich. It's a little higher than Deribit. And that's actually counterintuitive for a few reasons. One of them is if you believe that the implied volatility is a reflection of the delta hedging replication portfolio based on Black-Scholes, that means that you're assuming continuous hedging. And IBIT, continuous hedging means 9:30 to 4 p.m. You actually can't trade it from 4 p.m. to 9:30 the next overnight. but you can with Bitcoin, you can with Deribit. So actually, if you really thought agnostically, what gives me more optionality for monetization of that gamma? Bitcoin spot does, not the Bitcoin ETF. And so in that sense, the Deribit options should actually, in my opinion, have a higher premium than the IBIT options, but it doesn't. And the reason is because institutions only can access IBIT. And if they want to take leverage, which sometimes this is the way they'll express it, is they can only trade IBIT options. So the real alpha is if you're able to trade both market, both on the crypto native side as well as the TradFi side, and actually build some of the conduits around that infrastructure for capital efficiency, there's actually a ton of opportunities. Yeah, there's no risk in the sense of there being like a structural constraint that would cause operational issues on the ETF side. The ETF ultimately is a trust product that owns the underlying assets and reflects the NAV every day. I would also share today, actually, Bitwise had its first in-kind processing through the Bitcoin ETFs. And so we're actually experiencing what we've always wanted as industry for a long time, which is the ability to actually build that bridge a little bit more seamlessly by permitting in-kind token contributions rather than just cash from the APs. So all of these are steps moving in the right direction to minimize potential choke points or operational breakouts. And I think that's ultimately going to create more seamless markets.
Bitcoin fell to a 7-week low on Tuesday as traders pulled back from risk after U.S. President Donald Trump's unprecedented dismissal of Federal Reserve Governor Lisa Cook, intensifying concerns about the central bank's independence. The assets have now slid nearly 12% from their August peak above $124,000, giving back much of the rally that had been driven by expectations of imminent Fed cuts. Amid this turbulence, Bitcoin still demonstrates a defining advantage over traditional commodities: its transparency. With openly available market depth and liquidity data, participants can detect momentum shifts and potential supply shocks more clearly than in opaque, fragmented commodity markets. This visibility provides sharper signals, even when broader market uncertainty weighs on price action. How does Bitcoin's transparency in market depth and liquidity give traders an edge compared to traditional opaque commodity markets? So stay tuned. If you value clear, data-driven insights into crypto cycles, don't forget to like and subscribe so you never miss an update. Thanks for watching, and let's see together how the next chapter unfolds.